What is going on, family? It's your favorite uncle, cousin, Tyrone Gregory, the self-employed tax guy. And in today's video, I'm going to show you what happens when you join together in happy matrimony, love, and taxes. We'll get to it right after this. Love. Love is an amazing thing. It's a great feeling, right? It's the feeling that gives us butterflies in our stomachs and makes us feel like we're walking on clouds, right? They say love makes the world go round. Like, everybody wants to be loved, even the IRS. Yes, contrary to popular belief, the IRS has feelings too, and they love love. As a matter of fact, they love it so much that they even embedded it into some tax laws. So I'm going to do my very best to explain the rules around what happens when love and taxes come together. Specifically, I'm talking about what happens when you get married and how it affects your tax return and tax filing. Because it seems as if a lot of folks don't know that this happens when you get married. Let me give a full disclaimer. I'm not responsible for what happens as a result of you watching this video. I don't want no comments or emails talking about now you single, you ain't dating, or you divorced, or you canceled your wedding. What you do with this information is on you or y'all if you decide to share this. All right, so let's get to it. First things first, let's talk about your filing options. The second your marriage becomes official, immediately you only have 3.5 options on how to file your taxes. Let me show you. As we can see from this tax return, the only 3 options for us married folk is married filing joint, married filing separately, and qualifying widow or widower. The 0.5 option, head of household, is a little bit more involved, so I'll explain that one in a bit. And if you plan on killing your spouse after watching this video, well, that's when you'll get to use the qualifying widow or widower option. So why is the filing option so important? Well, it's important for a few reasons. The first one is because of something called joint responsibility, meaning that if you choose to file as married filing jointly, you become jointly responsible for the outcome of that return, regardless of who made how much or who contributed what. You both are now equally responsible for the outcome of that return. Even if there's a separation in the future, you will still be jointly responsible for that particular return. On the other hand, when you choose married filing separately, you are only responsible for you. And I can hear it now. Oh, well, in that case, I'm just gonna file that way. I ain't gonna be responsible for them. Hold that thought. We'll come back to that in a moment. The second reason the filing option is so important is going to require me to try to explain how taxes work, which means that I'm about to cram years of knowledge into a small section. So bear with me. And before I dive, please know that, of course, there are lots of variables and other things to consider. So this is just to give you a general idea, all right? So here we go. When you file your taxes, you are going to end up either with a refund or a balance due. And that is determined by comparing the total amount of payments you've made towards your tax liability to the actual amount of taxes that you were liable for. Let me show you on the tax return. As we can see on line 24, that is your total tax, which is your tax liability minus any credits plus any additional taxes. But that is the amount that you are responsible for paying based on your taxable income. And so we then take a look at how much you've had withheld throughout the year and combine that with any additional credits to give us what is called your total payments. And you'll see that right here on line 33. So if line 33 is greater than line 24, you'll get a refund. However, if line 24 is greater than line 33, you'll owe. So as we can see, line 24 is an important number. So let's look at how we arrive at line 24. Line 24, your total tax, is based off of line 15, which is your taxable income. The higher line 15 is, the higher line 24 will be. Therefore, the goal is to get line 15 as close to zero as possible, right? Right. So how do we arrive at your taxable income? Well, we take all of your income from all sources, and remember, we are adding up both of y'all's income. And then we subtract any adjustments to arrive at what is called your adjusted gross income. And then we subtract the standard deduction from that. And this is where the filing option comes into play. As we can see here listed on the left side is a list of amounts that we can subtract from the adjusted gross income based on the filing status. Now remember, the goal is to get line 15, our taxable income, as low as possible, so the more we can subtract, the better. And the filing status that we choose determines that amount of money that we can deduct. And look at which filing status has the highest number. Can you see which one has the lowest? Also, your filing status will determine your overall tax rate. As you can see here, if you choose married filing jointly, your tax rate remains at 10% up to $19,750 of taxable income. Whereas if you were to choose married filing separately, you would be in the next tax bracket the minute you go over $9,875. So yeah, filing status is important. Okay, so now let me address those of you who said, I'm just gonna file separately because I don't want to be jointly responsible with them for nothing. Obviously, married filing separately has its place, or it wouldn't be on the tax returns. Yes, one of the benefits is separate liability. And in rare cases, there may even be some tax savings. But if you live in one of these 9 states, there is something that must be considered. And that is something called community property. Community property simply means that anything acquired during the marriage belongs to each spouse equally, regardless of who acquired it. And this is important to know for taxes because if you live in a community property state and you decide to file as married filing separately, the income is going to have to be added up and divided equally down the middle, and that amount is reported on each return. Let me show you an example. Let's say that spouse 1 made $60,000 for the year, and spouse 2 made $40,000 for the year. Well, 60,000 plus 40,000 equals 100,000. So therefore, each spouse would report 50,000 on their respective tax return. Let's look at another example. For this one, let's say that spouse 1 made $100,000 and spouse 2 made 0. Well, 100,000 plus 0 is still 100,000. So each spouse will still need to report 50,000 on their respective tax return. Still sounds like joint responsibility to me, but that's how that works. And of course, like anything else when it comes to taxes, there are exceptions. The main one is if the asset or whatever is producing the income was acquired before the marriage. If that's the case, it's not considered community property. So hopefully that brings some relief to somebody. Okay, so at this point, I know some of you may be thinking, what have I gotten myself into? Well, if done right, marriage can be a beautiful thing. For example, I've been married for, let me make sure I get this right, because if I get it wrong, y'all might not see me in any more videos, or if you do see me, I might be disabled. But as of this video, I've been married for 14 years and we've been together 17. And we've been filing jointly ever since, except for that one time when we let someone else file our taxes, which ended up being a nightmare. And ironically enough, that's how I ended up in taxes. But that's a story for another time. But speaking of stories, it's story time. I remember when I first started doing taxes. I do believe it was my second year, and I prepared the taxes for this newly married young couple. And of course, I was trying to give them the best customer experience possible. So I was trying to engage them in delightful conversation. And I noticed that the husband was quiet while the wife, she was full of excitement and was answering all my questions and even sharing some stories of her own. So when I finished the taxes and they agreed on the outcome and they signed, I hit the submit button. They left and I assumed that we were done. But they came back a few weeks later because they didn't get their refund and the IRS website didn't explain why. So I brought them back to my desk, had them sit while I called the IRS to find out what was going on. And so when I finally got an agent on the phone and they told me what happened, I disconnected the call and explained to them that the refund was taken to pay a past due child support obligation. And here's where it gets interesting. The wife was like, what? And I repeated it like no big deal because I've heard this happening before. But then she turned and looked at the husband with this really pissed off look and said to him, you have kids? And I was like, holy. Apparently, he failed to mention that. I looked at him and he was like, uh-oh. And she turned and gave me that fake smile, said thank you, and said to him, let's go. And out of all my years of doing taxes, I never seen him again. Who knows? Maybe she ended up filing as qualifying widower the next year. And I guess that story is an excellent segue to my next point. What happens if you file married filing jointly and find yourself in a tax situation you feel you shouldn't be in? Not like the situation I just described in that story, but still a situation that's unfavorable. Well, the IRS understands that things happen and that we sometimes get involved with folks who are not fiscally responsible. And so the IRS offers us married folks some relief. And that relief comes in two forms: injured spouse relief or innocent spouse relief. And the one you choose will be determined by the type of unfavorable situation that you find yourself in. Here's a hint. The answer is in the name. Let's go through them, shall we? We'll start with injured spouse relief because it's the simplest one of the two. It's used when you are owed a refund, but the refund is taken due to the other spouse's obligation. In this scenario, you would file Form 8379 and tell the IRS that you have been injured financially due to your spouse's prior debt and that you want what's yours. And what happens is the IRS uses Form 8379 to run a scenario to determine how much of that refund would you have received if you were filing on your own. And whatever that amount is the amount that they will send to you. So only the other spouse's part of the refund goes towards their debt. And then there is the innocent spouse relief. Normally, this one is filed when there is a balance due on a tax return. You are no longer together. It's been some years, and now the IRS is sending you letters because they want their money. In this scenario, you would file Form 8857. This is telling the IRS, hey, I know I was on their return and I even signed it, but I'm innocent. I had no idea what was going on. That's why this one is a little bit more difficult to prove. If you are on the return and you signed it, you technically should have been fully aware. However, there are situations in which someone can sign a return and not know anything. This mostly happens in cases of domestic or financial abuse. Someone could be in a relationship where the other spouse is manipulative, verbally or physically abusive, or all three. And as sensitive as that is, if you're going to file Form 8857 and claim to be innocent of some or all of a prior tax debt, you are going to have to really prove it. Although the IRS states that it keeps the information private, it does ask for some really personal questions. But that may be worth it to avoid owing the IRS $30,000. Okay, so before I forget, let me tell you about that 0.5 filing option. This is the head of household filing status. And this is the one that gets folks into trouble. 90% of the time when someone tells me that they are filing as single head of household, I immediately turn into a detective. And here's why. As we just discussed, legally, when you are married, you have two main options: married filing jointly or married filing separately. And in cases where your spouse has passed away, you can choose qualifying widow or qualifying widower. And oftentimes what happens is when you combine your income, you phase out of certain credits, which means that the refund isn't that large. Whereas if you were to file as head of household, you would get a larger refund. And that makes married people want to cheat the system. Now here's the thing. It is 100% possible to file as head of household and still be legally married. But there are just 3 stipulations, and all 3 must be met. And those 3 stipulations are: 1, you have to file a separate return. 2, you have to have a child that you can claim as a dependent. And when you are married, the stepchildren count as being yours. And 3, you must have lived apart during the last 6 months of the year. And that's the part that gets you. Yes, the first 2 are easy. File separately, have a dependent. But that last one though, that's normally not the case. To live apart during the last 6 months of the year means that the other spouse cannot live with you and has to have a separate permanent address that began no later than June 30th of that tax year. I mean, for the most part, if you are still legally married and not going through a separation or divorce, you live with your spouse, which means that you did not meet all 3 stipulations, and therefore you cannot legally claim the head of household filing status. But for the love of money, folks will still try. So if you are married and yet you are telling your tax preparer that you want to file single head of household, be prepared to prove that you and your spouse lived apart since June 30th. And if you know you lying, don't put that on no tax preparer. Use TurboTax and tell the lie yourself. Tax preparers don't want to be jointly responsible. All right, I'm going to end this with a bonus tip for all my single folks who may be watching this and are out there in the dating world. If you find yourself headed towards a serious or committed relationship, check the tax return. The tax return reveals a lot about a person. It shows their financial health and behaviors. I know it sounds intrusive and personal, especially when you're just dating, but trust me, this is something that you want to know. Let me break it down for you. Here are a couple of scenarios and questions to consider asking yourself when it comes to the tax return. Scenario 1, if they don't have a tax return. Questions to ask yourself or questions to consider are they getting money? Because everyone who makes money has to file taxes unless they make under a certain amount, which is something else to consider. Also consider if they are making money and they don't have a tax return, you want to ask why. Is the type of money that they're making can be reported because it's illegal? Or could it simply be that they are making legal good money and just haven't done it? But you have to know this because this is what you are about to commit to. Scenario 2, they have a tax return, but the amounts don't match the lifestyle. Questions to consider are, what are their priorities? Meaning, are they making good money but claiming exempt all year so they can afford these lavish things? In this scenario, most likely they owe money to the IRS and state agencies, and if they aren't disciplined enough to withhold the required amount, who do you think gonna help them pay that debt? And scenario 3, this one is the same as scenario 2, except for this time they didn't go exempt, but the total income is still extremely low. The questions to consider here are they lying on their tax return? Are they saying that they had a business which took a loss? Which, don't get me wrong, this can and does happen often. But what also happens often is the lies. So do your due diligence. Find out which one you are dealing with. And the reason is because if it's ever found out by the IRS, then there is going to be a debt owed. And if they couldn't or wouldn't pay it then, who gonna pay it when it comes due? At the end of the day, whether you are married or just dating, when it comes to finances, it's important to have a healthy financial conversation. Discuss goals, budget, plans, etc. Just don't assume. And then have those conversations often. Schedule them if you must. And you want to do this because goals and projections change, especially when the economy changes. So you want to make sure that the conversation stays healthy and current. Alrighty fam, that's it for me. Make sure that you hit the like button, subscribe to the channel, and hit the bell notification so you'll be notified when I drop the next video. And until then, know that I love you, and I'll see you in the next one.